Okay, it's Thursday and finally the market seems to be correcting. I've been looking for a correction over the last week. Now that the markets on crack have just, doing their thing. I mean, have this almost 40% downturn in stocks and then just go right back up, at least the NASDAQ and NASDAQ 100 to new highs. And I did forecast that was likely to happen. I mean, that the NASDAQ did not break its trend line up in that whole bubble from 2009, like the S&P and Dow and transports and Russell 2000 and everything else did. So that has been the lead dog, and that was looking like it would make a new high before this was over. And we had that happen over the last few days. First the NASDAQ 100 and then the NASDAQ. But of course, that's resistance. And the NASDAQ played with this 10,000 level, a little above it for a few days. And finally, today with the Dow down 700-800 points and the NASDAQ down closer to 2%. Actually, the small caps, which always goes down the most, were down 4% this morning. I saw it last. So this looks like the beginning of that correction. And since it was such a strong rally up with so much dumb money, I've also shown recently, it's the small traders on call options playing this thing, and they're even buying Hertz and American Airlines and stocks like that when they're down. And by the way, Hertz yesterday in one day after a bounce went down, lost 40% in one day. So the dumb money is what they are. And if you're trading, and some of our people do, you can be the smarter ones, So we warned about this correction. I think it could go down about 15% from the top, or even 20% like for the Russell 2000 or a little more. I'd say the best target for this correction, and really would be the optimum target, is go back to May 12th, 13th lows. We kind of had a first move up, the first substantial minor correction, and then this straight up wave. So that would be a really good place. That would say, okay, we have our first wave up, and then we've had our correction against that, and then we have our final wave into August, and or as late as October, just before the election. The normal 5-month bounce like we got, in the 29 to 31st crash and bear market rebound lasted 5 months. That would put us into, say, late August. It could go longer because of the election. And a lot of that's going to depend on how Donald looks. And Donald's not looking so good right now. He doesn't seem to be learning from saying the wrong things. He just doubles down on whatever he says. So whether you like it or not, his ratings are going down. Right now, the polls would say he would not win. And the later articles in the last week, what the market's doing so, the markets don't care if Donald loses. Baloney. A Democrat coming in, and I know Rodney would agree with me the 9900%, it means raising corporate taxes, it means raising taxes on the rich for sure, especially if the Democrats can carry the Senate by just one senator. And that is a bubble killer. The corporations are almost all the buying behind their own stocks. I've shown that in many charts in the past. And of course, the richest people, the top 0.1%, 1% control 40% of the wealth, and the top 20% control 88% of financial assets. So if these people get taxed more in corporations, bad. So that's one of the things that could really stop this bubble. And the fact that, look, I've been saying recently, look how exponentially we're going up here. We went from a $1 trillion a year deficit, that's 6% of GDP, which is stimulus, government spending more than it's taking in. That is direct stimulus in the economy. 6%. And we still in the past have only got 2% growth. That went from $1 to $4 trillion in just one congressional bill, and they're already working on the second one, so it could be another 2 trillion. Somebody's saying we could end up with an 8 trillion deficit from an already baked in the cake now 4 trillion. So those sort of things mean you got to issue tons of bonds. People do start worrying bond yields may go up. All these sort of things, and higher interest rates long term is not good for corporate borrowing or for this rally or the valuations of stocks. And of course, there's defaults everywhere that can happen. The emerging world is in really bad shape with the China's Belt and Road. They've lent tons of money to poor countries all throughout Eurasia and Africa that cannot afford this stuff. You got other emerging countries who've loaded up with debt with cheap dollars and euros only after the recession and our big printing program. And of course, we have the highest percentage of non-A rated corporate bonds, lower rated investment grade and junk bonds ever. So there's plenty to go wrong here. I say it's going to happen by late this year. The real question is, it's possible with the NASDAQ hitting slight new highs that this was the rebound rally. I still say we're starting a correction that looks serious. It ought to last into late June, early July or so. If we can hold those levels around mid-May and start to head up again, now we can really focus on selling real estate, which you should already be doing because that takes longer, but looking for the optimum place to get out of stocks. And I tell you, I warned some people, you want to get out half or more because you're more conservative, this would have been a good time to do it before this correction set in. So let's watch this correction. Of course, I'm going to be on this, keeping you updated. And this would say that if there is another wave, and that would be the most likely scenario here for the past bubble crashes and bear market rebounds, it should go at least back to those highs on the NASDAQ and probably a little higher. And we could see, and I showed this on Tuesday, we could see the S&P get back near its highs or retest the highs, which would really be cool for people to get out of stocks at the best prices. So we'll keep you updated. The world turns. This bounce has been stronger than usual, but nothing unexpected about that, with an extra $3 trillion in fiscal stimulus and another 2 or 3 coming. And they've already in 7 months printed as much money almost, and will be there within the next month, as they printed in the entire QE cycle of the last 7 years by the Fed. So markets on crack, but markets aren't going to get past this year. That's my forecast. And we will see the biggest crash since 29 to 32. And not many people are going to see it coming, businesses or investors. So keep tuned.